I am William. I turned $1,000 into $1 million. Have you ever wondered what it takes to turn a small investment into a fortune? Imagine you start investing with just $1,000 and turning it into a life-changing $1 million. Sounds too good to be true? In this video, I'm going to reveal the secrets behind real-life success stories and show you how smart investments can make this dream your reality. There's one critical strategy that sets millionaire investors apart: holding for the long term. It's not a flashy trick. It's simply responsible investing. But let's be real, it's not easy. When markets dip and stocks plummet, panic sets in, and the urge to sell can feel overwhelming. The truth is, any stock that has made millionaires didn't do it overnight. It happened over years, sometimes decades, and during that time, those stocks likely experienced severe losses, maybe even multiple times. Staying confident in your investment thesis during tough times is the real test. But if you hold on through the turbulence, the rewards can be incredible. Today, we're diving into the strategies that turned $1,000 into $1 million for some of the world's most successful investors, from Amazon to Apple and beyond. We'll explore how they did it, and more importantly, how you can do it too. Make sure you stick around, because by the end of this video, I'll share practical, actionable steps that you can take to transform your $1,000 into a potential seven-figure success story. Get ready to discover the key to unlocking your financial freedom. Let's start with Amazon. AMZN. Amazon started in 1994 as a small online bookstore, founded by Jeff Bezos in his garage. Bezos had a vision to create a platform where customers could find and purchase books online, a revolutionary idea at the time. Despite skepticism, Amazon quickly gained traction, growing its catalog to include music, videos, and eventually, nearly every product imaginable. By going public in 1997 at just $18 per share, Amazon provided early investors an unprecedented opportunity for growth. One of Amazon's most significant advantages has been its commitment to innovation. Bezos emphasized creating a customer-centric company, introducing concepts like one-click purchasing and personalized recommendations. Later, services like Amazon Prime offered unmatched convenience with fast delivery and exclusive streaming content. These innovations not only attracted more customers, but also made Amazon an integral part of their lives, leading to consistent revenue growth. Amazon's success lies in its ability to diversify its revenue streams. The introduction of Amazon Web Services, AWS, a cloud computing platform, turned Amazon into a tech giant, providing the company with substantial profit margins. Additionally, ventures into entertainment, like Prime Video, and acquisitions, such as Whole Foods, helped Amazon dominate multiple sectors. For investors, this demonstrated the power of investing in companies that continuously innovate and expand into new markets. Lessons for investors like you should learn. Amazon teaches investors the value of spotting companies with visionary leadership, scalable business models, and a culture of innovation. Early Amazon investors benefited by believing in the company's ability to reshape industries and holding their investments for the long term, even during market downturns. Identifying companies that solve everyday problems with unique solutions can lead to significant returns. If you're finding this valuable so far, don't forget to hit that like button and subscribe to the channel. It helps us create more content like this and keeps you updated on the smartest strategies to grow your wealth. Now, let's consider Apple. AAPL. Apple began in 1976 as a personal computer company, co-founded by Steve Jobs and Steve Wozniak. While its early years were marked by innovation, Apple faced significant challenges in the 1990s. However, the return of Steve Jobs in 1997 marked a turning point. With a focus on sleek design, functionality, and user experience, Apple began a renaissance that would revolutionize the tech industry. The launch of the iPod in 2001 was the beginning of Apple's journey into consumer electronics beyond computers. This success was followed by the iPhone in 2007, a groundbreaking product that defined the modern smartphone era. Apple continued diversifying with the iPad, Apple Watch, and AirPods. These products, combined with software ecosystems like the App Store and iCloud, created a loyal customer base that kept returning to the brand. The third powerhouse in the list is Home Depot HD. Home Depot was founded in 1978 with a simple yet powerful mission: to provide a one-stop shop for DIY enthusiasts and professional contractors. Its warehouse-style stores offered a wide selection of tools, building materials, and home improvement products at competitive prices. This business model disrupted traditional hardware stores and quickly positioned Home Depot as a leader in the retail sector. Home Depot's success can be attributed to its aggressive expansion strategy and focus on customer needs. By opening stores in key markets and leveraging its supply chain to keep costs low, the company gained a competitive edge. Furthermore, Home Depot prioritized customer education by offering workshops and how-to guides, creating loyalty among DIY homeowners and contractors alike. For investors, this approach ensured steady growth and reliable dividends. Lessons from these three companies we learn and insights to apply. The stories of Amazon, Apple, and Home Depot highlight the potential of investing in companies with strong leadership, innovation, and adaptability. To replicate their success, investors should look for businesses that dominate their markets, expand into new sectors, and create long-term value. Conduct thorough research, monitor market trends, and focus on industries poised for growth, such as technology, renewable energy, or e-commerce. Most importantly, practice patience, as the most significant returns often come from holding investments for the long haul. By following these principles, you can position yourself to turn even modest investments into substantial wealth over time. Think you've seen the best strategies so far? Stick around, because the next section could be the game changer that sets your investments apart. From spotting industry disruptors to mastering dollar-cost averaging, we're diving into the strategies that could turn your $1,000 into a fortune. While I can't tell you the exact low-profile companies that will become the next big names like Amazon and Apple, here are 12 key strategies for identifying high-growth stocks and turning $1,000 into millions. First, research and due diligence. The foundation of successful investing is thorough research and due diligence. Start by analyzing a company's financial health through its income statements, balance sheets, and cash flow statements. Look for consistent revenue growth, manageable debt levels, and profitability trends. Beyond numbers, assess the company's market position, how well it competes in its industry, and whether it has a unique selling proposition that sets it apart. Additionally, consider its growth prospects. Is the company operating in a growing industry? Does it have a clear plan for expansion or innovation? The more informed you are, the better equipped you'll be to spot potential high-growth opportunities. Second, long-term investment perspective. The real magic of investing lies in the power of compound growth, which rewards those who stay the course over an extended period. High-growth stocks often take years, if not decades, to deliver substantial returns. Companies like Amazon and Apple didn't create millionaires overnight. It was the result of investors believing in their potential and holding onto their shares during both peaks and valleys. By adopting a long-term perspective, you not only give your investments time to grow, but also avoid the pitfalls of emotional, short-term decision-making driven by market volatility. Third, diversification. Diversification is a crucial strategy for mitigating risks and ensuring stability in your investment portfolio. Instead of putting all your money into a single stock, spread your investments across various sectors, industries, or geographic regions. For instance, combine high-growth tech stocks with stable dividend-paying companies or emerging markets. This approach minimizes the impact of poor performance in one area while allowing other investments to thrive. Diversification doesn't guarantee profits, but it significantly reduces the risk of significant losses, which is essential for long-term success. Fourth, risk management. Managing risk is as important as identifying growth opportunities. Start by setting stop-loss orders, which automatically sell a stock if it drops below a certain price, protecting you from substantial losses. Stay informed about market trends, economic indicators, and news that might affect your investments. Regularly review your portfolio to ensure it aligns with your financial goals and risk tolerance. Lastly, never invest money you can't afford to lose. High-growth stocks come with inherent risks, but by implementing these risk management strategies, you can safeguard your investments while maximizing potential gains. Fifth, focus on industry trends and disruptors. High-growth opportunities often arise in industries undergoing significant transformation or growth. Pay close attention to sectors that are poised for disruption, such as artificial intelligence, renewable energy, biotechnology, or fintech. Research companies that are leading these changes with innovative products or services. Look for businesses with first-mover advantages, patents, or technologies that can set them apart. By identifying companies aligned with these trends, you position yourself to ride the wave of industry-wide growth. Sixth, evaluate leadership and management. The leadership of a company plays a critical role in its success. Study the management team to assess their track record, vision, and ability to execute strategies. Companies led by experienced, innovative, and ethical leaders tend to perform better in the long run. Look for CEOs and executives who prioritize shareholder value, foster innovation, and navigate challenges effectively. The ability of a leadership team to adapt to changing markets can be a strong indicator of a company's potential. Seventh, monitor competitive advantage. Economic moat. An economic moat refers to a company's ability to maintain a competitive edge over its rivals. This could be through brand recognition, proprietary technology, cost efficiency, or network effects. Companies with strong moats like Apple's ecosystem or Amazon's logistics network are better positioned to sustain growth and profitability over time. When selecting stocks, look for businesses with durable competitive advantages that can fend off competitors and maintain market share. Eighth, emphasize revenue streams and scalability. Evaluate how a company generates revenue and its potential to scale. Companies with diverse revenue streams, recurring income, such as subscription models, or the ability to expand into new markets, have a greater likelihood of sustainable growth. Scalability is particularly important. Companies that can grow revenue without a proportional increase in costs are more likely to achieve significant profitability and investor returns. Ninth, consider dividends for stability. While high-growth stocks are often associated with reinvested earnings, consider balancing your portfolio with dividend-paying stocks. Dividends provide a steady income stream, which can offset losses during volatile periods. High-growth companies that begin paying dividends, like Apple, often signal financial health and consistent profitability, making them a worthwhile consideration. 10th, stay disciplined with valuations. High-growth stocks can sometimes be overvalued, driven by market hype. To avoid overpaying, focus on key valuation metrics such as price to earnings, PE ratio, price to sales, PS ratio, and free cash flow. Compare these metrics to industry peers and historical performance. By investing at a reasonable valuation, you reduce the risk of short-term losses and improve your potential for long-term gains. 11th, leverage dollar cost averaging. Instead of investing a lump sum, consider using dollar cost averaging, DCA. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. DCA helps you avoid timing the market, reduces the impact of market volatility, and ensures you continue investing during downturns, potentially acquiring stocks at lower prices. 12th, focus on small-cap stocks with growth potential. While large-cap stocks like Amazon and Apple are attractive, don't overlook small-cap companies with strong growth potential. These companies are often less established but can offer higher returns if they scale successfully. Look for small caps with innovative products, niche market dominance, or expansion plans that could lead to substantial growth in the coming years. Now that you've learned these proven strategies, it's time to put them into action. Let us know in the comments which strategy you'll be focusing on. And before you go, hit subscribe so you don't miss out on more insights that could change your financial future. Start investing today. Your $1 million journey begins now.